Hey guys, welcome back to another Ask a CPA video. Today's question comes from Daniel in Knoxville, Tennessee. Daniel asked, I got married last year and I'm wondering if we should file a joint tax return or if we should continue to file our taxes separately. Well, choosing between married filing joint and married filing separately impacts more than just your tax forms. It affects how much you owe or will eventually get back, while filing jointly often results in greater tax benefits. Every couple situation is unique, so let's break down the differences to help you decide which option is best for you and your spouse. So filing a joint tax return with your spouse has several advantages, including, first of all, you get a higher standard deduction. So for 2024, joint filers can deduct up to $29,200 compared to $14,600 per person for separate filers. Another point is you get access to more tax credits. So filing jointly allows you to qualify for valuable tax credits like the Earned Income Tax Credit, the American Opportunity and Lifetime Learning Education Credits, the Child and Dependent Care Credits, and the Adoption Expense Exclusion or Tax Credit. Another benefit of filing joint is higher income thresholds for deductions. Now, joint filers may qualify for deductions even with a higher combined income compared to separate filers, so filing separate. Now, these benefits often lead to lower overall tax bill for couples filing jointly. Now, guys, if you're finding this video helpful, make sure to hit that like and subscribe button down below for more great tax and accounting tips and tricks. We really appreciate all the love and support. Now, when does married filing separately make sense? So, while most couples benefit from filing jointly, there are a few situations where filing separately could be more beneficial to you as a tax filer. So the first one's going to be for medical expenses. So if you or your spouse had a large amount of medical expenses, filing separate may benefit you because you will surpass that 7.5% of your adjusted gross income threshold to deduct those costs. We shot a separate video on medical expenses, so check out that video for more information on how to maximize those medical expense deductions. Next is the student loan repayment plan. So some income-driven repayment plans calculate payments based on your adjusted gross income. So filing separately could lower those payments for borrowers on these specific repayment plans. Next is going to be for divorce or legal separation. So if you're separated or in the process of divorcing, keeping your finances separate by filing separate tax returns may be a better choice for you. And finally, tax liability protection. So if your spouse has tax issues such as unpaid taxes or they're under an IRS audit, filing separately may protect you from being held responsible for their separate tax liabilities. Now, there are a few downsides to filing separately. So filing separately often means losing out on key deductions and tax credits. Now, let's take a look at a few of these credits or potentially missed deductions. First is going to be the smaller IRA deduction. So joint filers get a larger IRA contribution deduction compared to separate single filers. Next is going to be the no student loan interest deduction. So separate filers cannot deduct student loan interest, which you can deduct if you're filing joint. Next is lower capital loss deductions. So capital loss deductions are limited to $1,500 per person instead of the $3,000 you get when you're filing joint. Next is higher tax rates. So separate filers may face higher tax brackets than joint filers with the same combined income. Now, there are some separate rules for married filing separately. So the first one is if one spouse itemizes their deductions, then the other spouse must also itemize. One spouse can't take the standard deduction and the other spouse take the itemized deductions. Next, on shared deductions like mortgage interest, now that must be split between both spouses. You can't push all the deductions to one of the spouses. Next is you can't switch from separate to joint filing after the tax deadline, but you can amend from joint filing to separate filings within a 3-year tax period. So, who can file jointly or separate? So, if you're married as of December 31st, you can file jointly or separately for the entire tax year. If you are living apart but legally separated, you'll still be considered married for federal tax purposes. Now, what if your spouse passes away? You can still file jointly for that tax year in which your spouse did pass away. What about common law marriages? So, if your state recognizes common law marriages, you can still file as a married couple. Now, we get this question a lot is can you still file as single if you're married? And the answer, unfortunately, is no. If you are legally married, your only filing choices are either going to be married filing jointly or married filing separately. Now, there is one exception if you qualify as head of household, supporting a dependent and living separately from your spouse for over half of the year. You may file as head of household instead of married filing joint or married filing separately. So, which filing status saves you the most? Now, the best way to decide this is to calculate your taxes both ways and compare the outcome. Now, many tax software programs can do this for you automatically, and I recommend that you go through this option and with the results to figure out which is the lowest tax bill. Now, you may want to hire a tax professional or a CPA to help you decide on which is the best route for your specific tax situation. Now, the final tip, guys, if you're unsure which filing status is best, consult with a tax professional or a CPA. Use an online calculator and compare your expected refund or tax bill. Now, guys, if you found this video helpful, make sure to give it a thumbs up. Hit that subscribe button for more videos for Ask a CPA. We'll see you in the next video. Take care.